Good morning, those who joined us from New York. Good afternoon for those who are joining us from Europe, and good evening for those who are joining us in the GCC and Asia. Thank you for taking the time. Today is a webinar around private credit. It is a webinar organized between TFO, the family office, a wealth manager based in the GCC with offices in Bahrain, Dubai, and Riyadh, and really covering affluent segment, high net worth, ultra high net worth, and providing them access to institutionalized portfolio management on the private market side. Myself, I'm based in Zurich, and we are part of Petiole Asset Management. This is the asset management arm. We are based in Zurich, New York, Hong Kong, and we are providing the access and the institutionalization from manager source selection to deal selection, due diligence, and portfolio monitoring, all in a portfolio context in private markets, real estate, private equity, and private credit. Today, I'm very glad to have with us Shahab. Shahab, I've known him for many years now. He's a managing partner today at Catterton. We'll get to know more about Catterton. He was a founding member and a co-founder of the private credit group at Adam Street before joining Catterton. He also have had experience at Oaktree before that. So we're talking to somebody who has seen various market cycles on the private credit side and have started even before this asset class becoming more and more present in institutional clients. So love to hear from him about his thoughts. And the reason we really thought about private credit, because this asset class is becoming more and more institutional. We were just chatting before we start on the webinar. If you think about the numbers today, private debt represents $1.5 trillion of assets. This is not a small number. And when you think about the high yield and the leveraged loan market, it's around 3 trillion. So private debt represents half of the credit market today. At the same time, if you look 5 years back, 2018, this was half. So we were talking around 725 billion. And 10 years back, it was in the 300 to 400 million. So this asset class has been growing and almost doubling every 5 years. And there is a reason for this, and we're going to be talking about it. But it's clearly an asset class that should not be overlooked anymore by institutional investors. So that's about my introduction. We'll have a lot of Q&A. There is also a room for you all to ask questions. Please do ask the question, take advantage. We're going to be trying to do between 30 to 45 minutes discussion on this topic. Shahab, thank you so much for joining us from your New York office.
It's good to be here. Thank you for having me.
Before we start on the private credit asset class, I always ask people, to walk us through their personal journey and experience in this field. What got you into this asset class and in the beginning, and what keeps you in this asset class as well?
No, happy to share that. So I guess my journey started over 20 some odd years ago. I went to undergrad at Wharton, and like most people in Wharton, I studied finance, and I was always interested in investment banking, but in particularly, I was interested in kind of the leverage side of investment banking. And, I was unfortunate to graduate in 2002, which was probably a very tough time to be out looking for a job. It was just coming out of the .com bubble. And I think I got 2 offers. One of them happened to be from the leverage finance team at Salomon Smith Barney. And that was really the first time I got access to an exposure to the credit world. And I really loved it. It was all about providing capital solutions, both from a bank loan side to high yield to corporate borrowers. So I got exposure to not only the corporate side of things, but also other private equity sponsors who were doing leverage finance or leverage buyouts, M&A activity that needed some sort of debt capital. But, I spent a couple of years in the leverage finance team at Salomon. And then, as it so happens, I wanted to move to the buy side. There weren't that many firms at that time doing private credit. Frankly, it wasn't even called private credit back then. It was essentially the mezzanine finance business. And one of the firms I talked to was Oaktree Capital, which, as most of you know, is one of the largest credit managers out there today. So I joined the mezzanine debt business at Oaktree back in 2004. And the focus of that business was providing junior debt capital to middle market sponsor-backed companies. And I had 12 very successful years at Oaktree, investing through the time leading up to the financial crisis, managing portfolios through the financial crisis, and then really the explosive growth that we've seen that kind of happened after the financial crisis. And we'll talk a little bit about that. And after 12 very successful years at Oaktree, I co-founded the private credit business at a firm called Adam Street Partners, as you know. Again, the focus was investing and providing capital to middle market businesses and really across the capital structure, from first lien debt, second lien, and even some junior debt. And last year I joined Catterton with one of my old partners from Oaktree to build out our private credit business here. So I've been in the industry for pretty much my entire career. There's, I think, few people who, like me, have done that, and kind of have seen the evolution of the industry. And like you said, the industry has been doubling from an AUM perspective every 5 years. And that growth is kind of expected to continue as we look towards the future as well.
So we'll deep dive on this, but who is Catterton? Because that's not a private credit shop. It's known to be more of a private equity. But tell us more about it, and what are you trying to do, you and your partner in this?
Yep. So like most private credit managers today, the big ones that we all know of, they were all private equity firms essentially back in the day, and private credit grew as an extension of these firms, and today private credit happens to be the larger part of those businesses. And Catterton is no different. Catterton is the world's largest consumer-focused alternative asset managers. We, I think, are synonymous with consumer. The firm has been around for the last 35 years. Today, we manage roughly 34 billion of assets under management across 9 different strategies. These strategies are predominantly on the private equity side and predominantly regional strategies. But we provide capital to companies all the way from the early growth stage to the large buyout stage. And we do it geographically. We have funds operating in the US, in Europe, in Asia, in Latin America. We have a real estate strategy, an impact strategy, and credit is the latest strategy, and really the extension of the overall platform. What makes us unique are, there are a few things that make us unique. One of them is our partnership with LVMH. As you know, LVMH is a large strategic partner of ours. That's the L in Catterton, and it provides us with a lot of insight, strategic knowledge, deal flow, etc. And in that respect, it's very, very unique. The other thing that makes us unique is how broad our definition of consumer is. We think of consumer as 60 to 70% of the GDP. That's important because we invest in businesses that are driven by consumer preferences, and you can imagine pretty much all the businesses generally have some end touch point to the consumer. So these are businesses in the healthcare space, in the consumer services space, as consumer products, food and beverage, pet, fashion, restaurant, etc. You name it. We have, over the last 30 or some years, we've invested in about 300 companies that touched a kind of wide variety of industry segments in the global economy. And we're an all-weather strategy that we have has been able to produce very consistent results over a long period of time. So the genesis of the private credit strategy was, and I've known the Catterton team for a very long time. We see everything, a lot of those opportunities, and we see about 800 deals a year just in the US alone. And Some of them are attractive from a private equity standpoint, but we're doing a fraction of those on the PE side. But a lot of them are attractive from a credit perspective. And we have really unique insights into these businesses that virtually no other firm has because of our history in these space. And so the idea is to combine our market knowledge, our consumer insights, our deal origination engine with a very experienced team that we've put together to be able to build a diversified private credit platform and be a real value-added partner to these businesses. So we can provide debt capital, equity capital to companies who are looking for growth, M&A, buyout, you name it. So it's really become a one-stop shop for capital needs for middle market businesses.
Got it. I mean, let's go on the private credit, but I'm curious to know, since you talked a lot about consumer and insights into the consumer, what would be the top 3 themes that you guys are excited about on the consumer side? I know you map various other, but if you were to name the top 3, what would that be?
Yeah, no, there's a lot. There's health and fitness. There's wellness. There's kind of there's a whole theme about humanization of pets, amongst many others that we look at. So if you look at, our history, we basically, our consumer insights team came up with the concept and thought about humanization of pets and how pets were becoming more and more important and valuable to, folks in society. And so we started investing in that category 10, 15 years ago. In the US first and now globally. I think we have about 12 or 15 different investments that touch the broader pet category, from pet veterinary, from medicine to food, and you name it. Similarly, we have businesses that touch the health and wellness space, from a VMS category to other businesses that are into fitness and etc. So there are a lot of themes that we look at, and these are just a few of those. But constantly what we're doing is evaluating where the world will be in 5, 10, 15 years. These are broad themes, and then trying to find businesses that we believe in that have a strong brand, a strong market positioning in that particular segment that we can back and frankly create value and bring something to the table. I'll give you a small example. Birkenstock, as you may know, is a business that we recently took public, and it's a business we invested in several years ago. Obviously, the brand has been around for over 200 years, but we saw an ability to take that brand and enhance that brand into something more than just a traditional footwear company. And today you see Birkenstock being worn by a whole variety of audience, from 10-year-old kids to 80-year-old and everyone in between. And that's really a testament to the types of businesses we invest behind and what we bring to the table in terms of our strategic partnerships and our network and our ability to accelerate the growth of some of these businesses.
You just described what our family is, from 8-year-old to 80-year-old wearing Birkenstock. They're comfortable, but I'm not sure of the style. Anyways, okay. So what define private credit asset class? Let's start with the definition and why this asset class have been growing and doubling every 5 years.
Yeah, so the definition of private credit, has changed over the years. 20 years ago, it was a small, relatively niche asset class, predominantly junior debt capital, that was sitting behind the first lien senior secured debt that was provided by the traditional commercial investment banks. But today, fast forward to 2023, the asset class, like you said, is $1.5 trillion globally. And it encompasses a wide variety of strategies across the risk spectrum. And we'll talk about some of those strategies. But the common theme across all of these strategies is the debt is originated and provided and underwritten outside of the traditional banking system. It's done by managers like us, usually on a bilateral basis between the borrower and the lender. These tend to be bespoke solutions in a lot of cases. And there's real benefits from a borrower's perspective, how they've been able to access this asset class, but also what advantages it provides. You have speed of execution, you have certainty, you have customization, and especially in dislocated environments like we're in today, where the public markets are closed. Private credit today offers a capital solution that frankly didn't exist a decade ago. Now, what has caused the growth in this asset class really, I think, happened after the financial crisis. And it was twofold predominantly. It was the consolidation in the banking industry, and it was the increased regulations that followed the financial crisis. And if you recall, those of us who were around, a lot of the mid-tier banks and even the larger banks were consolidated into a handful of very, very large bulge bracket banks. And that took out an immense amount of capital from the system. At the same time, the increased regulations that followed hindered the ability of the banks to provide capital to these levered businesses. And that really gave birth to this asset class, in the sense that over the decade that followed, you saw an exponential growth. And that void was filled by asset managers like ourselves and other large alternative asset managers who had multiple strategies and who can provide flexible capital solutions to these businesses.
Okay, and then if we go one layer on top, additional, so you mentioned junior debt, you mentioned customization. So let's walk through the various category. If I am an owner of a business, and we're talking private debt in this world of corporate, not real estate debt, but it can apply the same principle applies, banks getting out of these fixed assets. But let's say I'm an owner of a business, I need to borrow, then the banks is not lending me, I go to a private debt provider. And then the private debt provider have certain customization that allows me to borrow. So what are the levels so that we understand the risk and return also characteristic of each of these different levels of debt?
So the largest segment of the private credit universe is what we call direct lending. Direct lending accounts for roughly 40 to 50% of the AUM. And direct lending is traditionally associated with senior secured debt that goes in the cap structure. And that's the first dollar in. And if you look at a company's capitalization as senior secured debt, it's junior debt, which could be their second lien or mezzanine unsecured debt, and then equity. So senior secured debt is the safest part of the cap structure. It's also the largest part of the cap structure. And hence it accounts for the biggest portion of the private debt universe. That senior secured debt was traditionally provided by the banks pre the financial crisis. Post-financial crisis, that void, like I said, has been mostly filled by managers like us. And so if you're a company or a corporate business looking to raise capital, you can come to lenders like us and other folks who look like us to raise that capital. The advantages, again, of investing in senior secured debt from an investor's perspective, obviously it offers strong downside protection. It's the first dollar in, you're secured by the assets of the business, it's low leverage, and it offers very attractive current income in today's environment and very attractive all-in returns. And we'll talk a little bit about the returns, but in today's market, the yields on these first lien loans have increased significantly. These loans are typically priced over base rates. So today base rates are 5% plus. They usually have a spread, some upfront fees associated with it. And today these first lien loans are yielding somewhere in the mid to high teens type of returns. That's almost double what it was a few years ago. So in my mind, it's a very attractive time to be investing in this particular segment of the market. Now, outside of the direct lending universe, you have what I would call the junior debt strategies, whether it's mezzanine debt, second lien debt, even some preferred equity. Those tend to be obviously higher up on the risk spectrum, and they typically price 200 to 400 basis points behind a first lien deal. Those strategies tend to be, in my mind, a little bit more episodic in nature, because there's sometimes in a cycle where they're very attractive from a risk return perspective. Other times they may not be so attractive. To me, and frankly to us, debt investing is all about capital preservation, downside protection. So you're always battling between risk and return. And so while the direct lending side of the market is more what I would call kind of all weather, you can really invest through different cycles and different parts of the cycles. Mezzanine or junior debt investing can be a little, there are certain times in a economic cycle that are more attractive than others. But it's a big portion of the market, as you would expect. Then tied to both of these are hybrid strategies, or what some may call capital solutions, or TAC ops strategies. These strategies are flexible in nature, where they allow the managers to invest across the capital structure, from first lien debt, second lien, junior debt, and everything in between. They can also invest in sponsor-backed businesses or non-sponsor-backed businesses. So they're more tactical in nature and more kind of fluid based on where the best opportunities lie at any given point in the cycle. And I think the last corporate strategy probably would be distressed. Now, distressed debt, we haven't had a traditional distress cycle in a very long time. So the distress strategies have morphed over the last decade or so. But traditionally, distressed debt tends to be at the very high end of the spectrum from a risk return perspective. Depending on what the strategy is, it could be about capital appreciation, less about income generation and more about capital appreciation. And you can generate more private equity style returns through distressed investing. But like I said, the distress cycle hasn't really happened in a long time, and that window tends to open and close very quickly. We saw a little bit of that in the early months of the pandemic, but then when debt started trading down, and even last year, but that window wasn't it wasn't open for a very long period of time. So those 5 or 6 strategies would be what I would broadly categorize as private credit strategies tied to the traditional corporate lending side.
Okay, and you mentioned many times risk and return. So let's assume direct lending, the risk, or any of these, right? The risk is default, right? That the corporate or the company you're lending to goes into bankruptcy, into default, and then you are, as a debt owner, have to do something. So if we look to as a direct lending, the risk of a default, what is the historical recovery rate on direct lending, because that's kind of the risk that you are underwriting, right?
Yeah. So that's an interesting question, because there's the industry default rates and industry recovery rates, but then really it becomes much more specific to the strategy and the manager itself. A lot of managers in the private credit arena, like I said, haven't really gone through a traditional default cycle, and very few have been around since the financial crisis, and most of them that we know as of today were started after the financial crisis. So we've seen some rolling recessions that are more industry specific. We've seen obviously market dislocations, whether it's the pandemic or the inflationary environment or the high interest rates, but we haven't really seen a more typical default cycle that that we saw back in 2008, 2009. Now, that said, generally, if you look at the market stats, middle market loans are capitalized better than the larger cap counterparts. So that means they have less leverage and they have much larger equity cushion. So they're better capitalized. They are also they generally they price at a premium to the public market counterparts. So on a relative value basis, you're less levered and you're getting paid more for that risk. And you look at the stats, they actually default less. And when they do, the recovery rates for middle market loans in the private credit market, the recovery rates are higher, which intuitively makes sense, right? If you capitalize a business well, and you put in the right protections from a covenant standpoint, from a documentation standpoint, they tend to perform better. The other nuance about the private world is these are loans that are held by one or two investors or lenders like us. When a company defaults, the lenders typically work with the company or the private equity sponsor who owns the company to come up with a solution that's in the best interest of everyone. And, obviously we have to protect our investment, but more importantly, we work towards a solution that will maximize our recovery. In a broadly syndicated setting, typically what happens is the moment a loan starts trading below par, the CLOs have a pressure to sell. Those loans get bought by a distressed investor, and they have their own motive to take the company through bankruptcy. So there's a tremendous destruction of value in a lot of those cases. Here, most of the time, people work together, arm in arm, and it's a relationship business. And usually, most of the time, you come out strong on the other side, and you fix the problems, and you come out stronger with a solution for everyone that works out. So, in our world, private credit, especially compared to the public market, offers, I think, very attractive relative value.
And when somebody is assessing a private credit strategy, what are the 5 things that somebody should look at?
It all depends ultimately on the investor's goals. What are you trying to achieve from a portfolio construction standpoint? Are you starting a new allocation to the asset class, or are you adding to an existing allocation? What is your risk tolerance versus your return expectations? Is current income generation important, or is capital appreciation important? And then, what are your liquidity needs? Whether you can be in a locked up fund, or you do need quarterly liquidity or annual liquidity, etc. The good news is today there's something for everyone. 20 years ago, you didn't have that many options. So when investors were looking to invest in the private credit world, it was more in their opportunistic bucket. I think today more and more investors have a dedicated allocation to the asset class. But there are, all-weather strategies like direct lending. So if you're building a portfolio, or you're deploying capital in an uncertain economic environment like the one we're in today, I think direct lending offers very attractive risk-adjusted return. If you're again starting from scratch and you want to build a generalist portfolio, you can invest in some of these funds that give you kind of market risk or beta. But if you have a mature portfolio, you can invest in more niche strategies or specialized strategy that give you a little bit more alpha than some of the larger players out there. Again, today we have a lot of new products. So there are products that address various tax implications, liquidity needs, capital charge requirements for our investors. So depending on who the investor is, you can do that. But I think regardless of where you deploy capital in the private credit arena, I think the most important thing is manager experience and track record. Find someone who's been tested through a cycle in a benign default environment, like the one we've been living in for the last 10, 15 years. The returns generally look the same, and there's not that much dispersion. But look at the vintage funds for managers who those funds went through either the COVID-related disruptions or the inflationary environment or some of these industrial recessions back in 2014 or 15 that I talked about. That's when you see the widest dispersion. So there's no substitute in my mind for experience. And so when you're evaluating these strategies, whether it's senior direct lending or something more opportunistic, always think through managers' long-term track record.
Okay. When you think about the current market outlook or the current market dynamic, so you said it's very attractive today compared to 2 years back for the same type of loan that you would be providing a corporate. Walk us through a number. What does it mean? So margin plus SOFR, but what is margin today? What is OID today? What was it 2 years back?
Yes.
So that we can get a feel of what could be expected return on this asset class today versus 2 years back.
So if you're deploying capital today and building a new portfolio, I think this is as attractive a time as I've seen in the last decade. I'll tell you why, but simply put, risk has gone down and returns have gone up for the same first lien loan from a couple of years ago. An LBO today versus a year ago has lower leverage. Traditionally, I think if I recall the numbers correctly, an LBO leverage was around 5.5, 6 times 2 years ago. Today, the same LBO has leverage around 4.75. Middle market LBOs, which are the way I think about middle market, are businesses with 50 million of EBITDA and less, have even lower leverage. So they're closer to 4.25. At the same time, equity cushions in these leverage buyouts have gone up, closer to 60% today versus 40%, 50% a couple of years ago. So the risk in these businesses has gone down significantly. At the same time, a traditional first lien loan today prices over a spread of LIBOR or SOFR. So SOFR today is 5.25. SOFR 2 years ago was 0, or LIBOR was near 0. And so you've picked up 400 to 500 basis points right off the bat just on the base rate. But spreads have also gone up. A couple of years ago, it was LIBOR plus, I would say, 450 to 550-ish range. Today, spreads are probably 550 to 650, 700 on a first lien senior secured debt. So just on the coupon alone, you're generating around 11-12% yield. That's very attractive versus 6%, 7% a couple of years ago. The other thing is you also get OID, or upfront fees, as we like to call it, and that's usually 2 to 4 points today. A couple of years ago, that was probably 2 to 3 points, so you also pick up a few points there. So on an unlevered basis, today you can generate returns in the low to mid-teens, I would say. Same like-for-like deal a few years ago would be in the mid to high single digits. If you can put a little leverage on the fund, you can boost up these returns by another 300 basis points. So you can generate high teens returns by investing in first lien senior secured debt. All at a time when leverage has gone down and equity cushions are up. So the deals are actually much better capitalized today, and you're getting paid for that risk. So for managers like us who don't have the burden of a legacy portfolio that you potentially have to manage through this environment, and I'll come back to that, you can build a portfolio in very, very attractive terms. And that's why I say I think this has the potential of being one of the most attractive vintage periods that we'll see.
Yeah. You know, the way we run our portfolios is we have a portfolio for income, and we run it in a diversified manner and a bit more dynamically. So one of the things we've been doing historically has been to extract income in the last 3 years from real estate financing. We felt dislocation have been around in the US for real estate financing. And then when the sell-off of 22 happened, we added public credit, because at that time we felt that you can go and buy high yield or loans on the public market at a discount and with a very attractive risk return. And this year we moved from public credit to private credit. And I would say we're kind of positioned to overweight the asset class, even though we haven't participated as much in the last 3 years on private credit for the reason that you mentioned, that one, equity cushion is higher, i.e. private equity managers are putting more of their own capital. Two, illiquidity is allowing you to get that premium of 6% versus maybe 5 or 4.5, and the OID. And three, SOFR, which is the variable at 5, given where rates are and the expectation of rates, we don't see SOFR going back to 0. It might maybe go back to 2-3%. You still have that margin, and in that sense, we like having this asset class as an overweight part of our income strategy today.
I think you're absolutely right. You've always been very thoughtful and tactical in your allocation, and I think this will end up being a very attractive period. The asset class has also gone deeper and expanded to a point where now the private credit managers are financing much larger deals than they were 5 years ago. It's obviously the dislocation in the public markets that's causing that a little bit, but the credit markets in the private side are also much deeper now. Managers have a lot deeper pockets, and they can finance $2, $3, $4 billion types of tranches for some of these borrowers, which frankly wasn't the case 5-6 years ago. So not only is the asset class growing, it's attracting even higher quality borrowers, and you're getting paid very handsomely for the risk you're taking. So I think when you combine all those things, it bodes very well overall for the asset class.
And when you overlay the 1.5 trillion today and into the need, because it's all demand and supply, so we don't end up into commoditization of this asset class. How do you reflect on this? So the demand from private equity sponsors and the supply of private debt in the market.
Yes, no, that's a very good question. And by any measure, 1.5 trillion of AUM is a very big number, and that growth has been exponential over the years. But it's always important to look at that in the context of the future demand for debt. And the two big drivers for debt demand, in the US at least, and frankly even globally, are the upcoming maturities for all the capital that was underwritten and done by the banks and managers that will need to be refinanced over the next 3 to 5 years. These are fixed maturity loans, and they generally need refinancing within that period of time. And then the capital needed to finance new leverage buyouts based on the dry powder available in private equity funds. So when you combine those two numbers, the future visible demand for debt just in the US alone is around $1.7 trillion. That's a very big number. The available dry powder in private in direct lending funds in the US is over $100 billion. So now think about the delta. You have $100 billion of dry powder, and you have a visible demand of 1.7 trillion. That's a delta of 15 times. So the long-term secular trends are very much in favor of the asset class. And like I said, this is why we expect the asset class to almost double in size over the next 5 years. And that's generally the expectation. In the foreground, we're going to continue to have cycles, and we're going to continue to, as managers, always maneuver around changing market dynamics. But the long-term trends are very much in favor for the asset class. The other thing that's happened is, like I said, the more and more borrowers, whether sponsor-backed or non-sponsor-backed, are coming to the private markets for their financing needs. These are businesses with even up to 500 million of EBITDA today are accessing that market. So I think that, again, shows you how far the asset class has come and, frankly, where the world is headed.
When you are doing your transactions, because there are questions around expected returns, these loans that you're extending are typically a 5-year loan, and then you expect to be repaid back earlier. Just walk us through that. And what does this mean if we're lending today at SOFR plus 600, if I was to take it into an expected return on a portfolio basis?
Yeah, so typically the first lien senior secured loans are 5-year maturities. They tend to get refied somewhere in years 3 and 4. It also depends a little bit on the uh, market cycle and where the world is. So if there's a lot of M&A activity or new buyout activity, the loans tend to get refinanced earlier. If the hold periods are longer, then the loans obviously stay out for a little longer. But typically, it's about 3.5 years is the average life of a loan. So today, if you invest in on an unlevered basis in a senior secured loan, you're generating, call it 12-13% type of yield. If you can build a portfolio with predominantly first lien debt, but even opportunistically some second lien and maybe a little bit of an equity co-invest, you could generate mid-teens type of returns over that 3-4 year period, and some healthy cash on cash return with a little leverage, because these are first lien loans, so you can actually put some fund leverage. You can boost those IRRs by another 300 basis points. So your returns could be in the high teens in today's environment, if you could build a diversified portfolio. The key is to make sure you minimize your loss rates. That's the only way you underperform in the debt world. And for us, it's always been about capital preservation and loss avoidance. You know our track record, it's zero losses over long periods of time. And we spend real private equity style, we do real private equity style underwriting for these businesses in order to generate those sort of consistent results over long periods of times, regardless of cycles. But to me, these returns are probably 500-600 basis points higher today than they were 2-3 years ago.
And there was a question on default rates. So let's overlay default. I know you guys have done very well, but let's say the industry, if you're able to generate 12-13% on an unlevered basis and you overlay a default rate and recovery rate, what does this end up with?
That varies again by what the default rates are. If it's for senior secured debt, these, on an annualized basis, it's usually, I think a good way to model this out is 50 basis points of default rates on an annual basis. But recovery rates tend to be much higher. So for middle market loans, those are kind of in the 80% range. So even if you model that out, on a net IRR basis, you're still generating very healthy returns compared to, frankly, other credit alternatives, both public and private.
Just because the recovery rate is quite high.
Recovery rates are much higher. Exactly. And these are first lien senior secured debt, so you're not behind any other debt in the cap structure.
Got it. I usually very strict on 45 minutes, but I feel like we want to extend it 5 more minutes if it's okay with you.
Absolutely.
Okay. No, I'm curious to know about the trends that you see gonna evolve in this asset class. Okay, of course, there's demand more than the supply. It will double over the next 5 years. But as it becomes more and more present in institutional portfolios, do you see the trends on regulation, ESG? I don't know what kind of trends you see yourself from market players, participants. Curious to know that.
Yes to all of them, because there's been obviously an evolution across the spectrum. So you obviously have a proliferation of strategies across the private credit spectrum, and those will continue. One of them is providing the birth of the secondary market for private credit. That did not exist 10 years ago, just because there wasn't enough LP demand, there weren't enough managers, there just wasn't enough history there. Today, there is a secondary business in the private credit space, which I think will ultimately become as large as the private equity side, if not larger, down the road. So providing LP solutions, etc. That's one trend that I think we expect to see continue. The other one is, like I said, the larger and larger borrowers are accessing this asset class. Before, it was 50 to 75 million EBITDA was kind of the top end of the range. And otherwise, you could access the public markets for cheaper financing. Today, I don't know what the top end of that range is. It's 300, 400, 500 million of EBITDA. So I think you've also kind of broken through that barrier, and that will continue. The third thing I would say is the access. Historically, this asset class was predominantly for institutional investors. Today, and more, it's being accessed by retail investors, high net worth individuals, family offices, because now we actually have products and vehicles that are catered towards that channel of the that distribution channel. So it's actually opened the door, and this is not just contained to the private credit asset class, but alternatives in general. Which I think is great overall, because it does give the average investor access to a product that frankly could be very additive to their portfolio overall. So we're going to continue to see that. So outside of those trends, I think we're also going to see a continuation of this, an expansion of the asset class from a geographic standpoint. US is always, I think, has been at the forefront and obviously the biggest market, but we've seen the proliferation in Europe. And we're going to see that in Asia as well, maybe even in Latin America. Now, the market environments in these regions are very different. US is one big homogenous place, but Europe and Asia have their own regional dynamics. So you have to be careful, and there are nuances around each region, but I would expect more geographic acceptance of the asset class outside of the US and Europe over the coming years as well.
I mean, the fundamental thing also is when you are talking about a recovery rate, you're talking about bankruptcy law and court, and right. So you need to also have that system working and evolving and mature for the asset class to also mature itself in those markets.
Exactly. I think that's you nailed it on the head. And I think that's the biggest issue in regions outside of the US and some parts of Europe, because of those jurisdictional laws and regulations are very different. And you have to really be an expert in those and make sure that they're lender friendly to allow you to recoup your investment if something goes wrong, and if you have to go through a bankruptcy court, etc.
What keeps you awake at night?
Not much other than my dog. But when I think about the overall economy and kind of where we are geopolitically, look, there's obviously a lot of things happening from a political, geopolitical, economic uncertainty. We have two wars in the world. We have an inflationary environment that, albeit is getting contained, and we're living in a high interest rate environment. And you know, a lot of these companies that had built their capital structures over the last couple of years haven't really seen the full impact of those high interest rates through their portfolio and on their balance sheets just yet. So I don't think we're out of the woods yet. And I do think we're going to see some uptake in default rates for these portfolios, for these highly levered businesses, as you know, their cash cushions shrink over time because of the high interest rates. So that, to me, I think you still have to be defensive and cautious of where you deploy capital, and you have to pick your spots. And this is where your knowledge and your insights and your experience really comes in, to be able to selectively pick credits in an uncertain environment that can withstand potentially some challenging times ahead. So when I think about those things, that's the one thing that gives me not a pause, but makes me want to be cautious and thoughtful and defensive. But at the same time, like I said, we don't have the burden of a legacy portfolio. We are building one in today's environment. So from a from a new capital deployment standpoint, I think this is a pretty healthy and attractive environment overall.
Very good. Okay, so we started with a personal question. Let's end with a personal also question. So for those of young guys who want to start in this industry, what are the key lessons or insights that you've gained in your career and that you would believe are valuable to them?
Oh, okay. I'll have to think about that one, but whether it's private credit, private equity, or frankly, any other industry, I think these lessons probably apply to all, and frankly, even your personal life. But reputation is very important. You know, it takes a lifetime to build a reputation, whether it's a personal reputation, institutional, and it takes a instant to crack it. So I've always told my team, always put our investors' concern ahead of ours, make sure we're always doing things in a way that's above board. And for lack of a better term, you never want to be on the front page of the Wall Street Journal for the wrong reason. So in our world, and frankly, in every business, reputation is hugely important. But on a personal level, you know, we are in an industry where I think people like to hear themselves talk a lot and not listen enough. And I've always found that if you can take the time to listen, whether you're in a meeting or a conference room or with your colleagues or even in your personal life, you can actually understand people's problems, their ambitions, what makes them tick. And in business or in personal life, you can address their concerns a lot better. And that's always served me right. And you can be a solutions provider. A lot of people can come up with problems and identify problems, but very few people can offer solutions. And I think the more you listen, the better you get at providing those solutions. And I think that's always served me right. And I think the last thing I would say, again, this is less to do with business, but more to do with where we are in the world. Just be a good human being. You know, take the time to mentor people, take the time to pick up the phone if a college student calls you and he wants career advice and work. It doesn't take much out of your day, but it can be a world of difference to that person. So whether it's work or your professional life or your personal life, you know, those few things have always served me okay. So those would be my parting words.
Amazing. Thank you so much, Shahab, for your time. Thank you all for joining us in this webinar. I hope you found it useful. And we will do a replay so you can go back if you want to listen further, or if you have any other questions, please reach out. Thank you all. Take care. Bye now.